Hi, my name is Art Lee. I'm a certified distressed property expert with WHB Solutions. Today, I'd like to discuss how a bankruptcy, foreclosure, or short sale affects credit scores. The team at WHB Solutions is constantly out in the field gathering intelligence to share with its clients, and this month our team attended an event with a credit expert from clearcreditexchange.com. There have been many recent arguments about how important a person's credit score is and whether it really matters if a troubled homeowner decides to file bankruptcy, go through a foreclosure, or attempt a short sale. So here's what people think. There's one school of thought that states credit is not that important unless you want to finance a home or purchase a vehicle. If you are able to rent and buy a used car paid in full, then you can take the hit on your credit score. Well, many troubled homeowners were put on loans with easier guidelines in the past, but currently the lending guidelines are fairly strict. It is the thought that many troubled homeowners probably won't be able to buy a home anytime soon, so who cares about the credit? Well, the other school of thought is that the credit is important for several reasons, even if you are not planning to purchase another home or buy a vehicle. For most Americans, credit cards are more important, even though the purpose of a credit card is supposed to be for convenience, not having to carry so much cash all the time and the ability to spend and make a few payments at the end of the month. But credit scores have been used when applying for a checking or savings account with a bank, for obtaining auto and medical insurance, renting an apartment or home, and in some cases when looking for a job. It is not a standard practice with many businesses, but it is becoming more relevant. Also, if you are a person that has little money to save every month, credit cards can be used in emergency situations to get you by until you have enough money to pay for them. Now, in our experience, we at WHB Solutions encourage troubled homeowners to go the route of a short sale if it makes sense for their situation. It is understandable that a troubled homeowner can give up easily and file for bankruptcy or just walk away from their home and take the foreclosure hit on the credit score. It may not be apparent to the homeowner now because their financial difficulties are so bad, saving the credit is really not that important. But the fact is, credit will affect them in the long run. From an event WHB Solutions has attended, we gathered some very good information on what happens to your credit score when you decide to file bankruptcy, go through foreclosure, or pursue a short sale. From our findings, Clear Credit Expert identifies the short sale as the best option with minimal impact to your credit score. So here are the details. In a bankruptcy, the credit scores typically will drop anywhere between 100 to 200 points. The length of time on the credit report is 7 to 10 years. Buying another home with most lenders, you are disqualified from getting a mortgage for about 2 years and sometimes even sooner, but interest rates and down payments will be much higher if you're trying to buy a home then. Foreclosure drops approximately 200 to 250 points. The length of time on the credit report is 7 to 10 years. Buying another home, you will be disqualified for a mortgage for about 2 to 3 years. This may turn to 5 to 7 years in the future. It depends how lenders are going to take a look at all these troubled homeowners in today's current market moving forward. Short sale. If you do a short sale, the credit score drops approximately 80 to 100 points. The length of time on the credit report is about 7 years. Buying another home, qualifying for a mortgage with a decent interest rate can happen in about 2 years. So the truths. There are several caveats when it comes to a short sale because short sales are relatively new in occurrence and credit bureaus are still trying to figure out into the credit risk modeling. In fact, in the future, it has been noted that some lenders may look at a short sale the same as a foreclosure. Now, the impact of credit scores that we stated, an 80 to 100 point hit for a short sale. This hit does depend on how many payments were missed prior to the completion of a short sale. For a short sale, it has been reported that a credit report will show satisfied with a note that states creditor settled for less than the amount due. And if you're lucky, you will get something that says paid in full. Lenders using the Fannie Mae and Freddie Mac mortgage approval system will see mortgage payments that are 120 days late or receipt of a notice of default the same as a foreclosure. Many lenders may not consider a short sale unless the homeowner's late. So those are just some facts there when dealing with short sales. Our opinion, in summary, it is WHB Solutions' opinion that credit scores will continue to be important in the future. And if you can avoid the extra 100-point hit to your credit score, it will take you less time to reestablish your credit. If you have no option for credit cards, your only option is to get a secured credit card where you'll have to deposit money to a bank, and they'll give you a credit card to use in the meantime. Or you just pretty much live by cash. Today, cash is king. The point being, if you are a troubled homeowner that is deciding what to do with your home that's underwater, you should consider credit scores as a factor in your decision making the process with looking into different options of what to do in your situation, and be sure to look at tax consequences as well. Now, note, if information that's provided in this video probably will change. This is what we have just determined as up to date, and we'll try to provide future updates. So look forward to our future videos on short sale strategies, lender trends, and anything related to the distressed homeowner market. Thank you for listening.